on an important day of trade in our studios is Manish Sonthalia. Needs no introduction. Manish, great having you. Thanks so much for taking the time out. And thanks for being here.
Thanks for having me, Neeraj.
No, the pleasure is ours. It's a good day, really. Manish, tell us, what does a money manager think like? Because there was uncertainty, tariffs, markets getting punished. Indian markets got punished before the tariff uncertainty came in as well, right? Now from 22,000, it's almost been a one-way move all the way to nearly 24.5. We've done more than 10% already from the lows.
Absolutely.
What's next?
So, it is all about temperament. At 22,000, plethora of pessimism all around. You got to barely hold your horses and believe that, this far and no further on the downside.
Sorry, I must say, you called it, right? At 22,800, he came in and said, 22,000 jayega, we might buy at those levels. So, sorry, please continue. Credit where it's due.
So basically even now, I think, 22,000 to 25,000 for the next 3 months is very much doable. If you were to cross 25,000 in a hurry in the next 3 months, again, you would be creating excesses on the upside. So I think the band is 22,000 to 25,000 in the next 3 months. Lot of uncertainties around the tariffs will be over. US has imposed 100% tariffs or more on China. China has imposed 100% tariffs on US. I don't think these numbers are sustainable. This is all brinksmanship. Either ways, this will all get settled between...
Saber rattling, yeah.
Yeah, so this will all get settled between 20 and 30%. So obviously, coupled with that, you look at the US, there will be tax cuts, etc. That will boost sentiments quite a bit. A lot of this is being preempted, is happening in the marketplace as far as the global markets are concerned. Global markets broadly have rallied from those equivalents of India's 22,000, except for the US, which has been falling. So I think that's where we are. It's a range. It's a range-bound market. Nothing has changed as far as the numbers are concerned. Earnings trajectory on the Indian market, Indian Nifty 50, stays good at that 10 to 12%. On the conservative side, consensus street estimates are still 14, 15%. Yeah. I would still believe 10 to 12%. Lot of uncertainties are there. It's rather, better to err on the side of caution. So 10 to 12% broadly at 25,000. You would be fully valued for the near term. I would believe it that way.
Okay. Of course, Manish, at these moments, the debates turn once again to those people that held cash. I'm talking about money managers. And in retrospect, everything seems flawless, right? As always. So when the markets were going through that turmoil, those that held cash were saying, wow, you knew something that nobody else does. But now in 6 sessions, as Neeraj is pointing out, we're talking about 1,800 points in the Nifty 50. It looks a little dicey. So would you say that the best strategy at this point, even now, is to be fully invested in the Indian equity market?
See, my 3 decades of money management tells me that human beings are not wired to time markets to perfection, right? No matter how dire the circumstances appear, and you keep a bit of a cash, and a bit of a cash is nothing more than 5, 7, 10%. If you go beyond 10%, then you're really taking a very bold call. And mind you, the benchmark is always invested, irrespective of all ups and downs in the global place, right? So if you were to be so sure that you tick all the boxes in terms of knowing what is about to happen, it will click maybe 1 in 10 times.
Even if you know everything?
Even if the world knows everything about everything. Markets are too smart. Markets are too smart. You will get it right 1 or 2 times out of 10 times. But the rest of the 8 times when you go wrong, it will take care of the 2 times where you have been right. So it's better that we don't try to fight the markets as far as the cash calls are concerned. Because, if you're fighting the benchmark and the benchmark is fully invested, you'd rather be somewhere close to what the benchmark is posing before you. That looks like a very big shortcut that you try to gain that alpha when something is on the momentum on the downside by creating cash. So it's very good to create cash. You get a comfort of mind that, you are right and the markets have fallen, but you really don't know when to buy it back.
Yeah.
That's the big problem. I have seen that even in Lehman crisis. Lehman crisis, everything was falling like line pins. And March 2009, when the markets turned, there was still a lot of funds which were holding a lot of cash. So it's a catch-22 situation, really, I tell you. And the best possible situation is keep 5-7% cash, that's good enough. But taking a 15, 20, 30% cash, I mean, you got to be really super confident in your approach, as far as the direction of the markets are concerned, which is rarely the case.
Super confident, or I suppose super negative. But then let's talk about the other extreme of it. And a bit of that being seen in Indian investors right now. Consistently optimistic, saying that no matter what, it will come back. And the markets have proven this time and again. Is that a bit of a foolhardy approach as well?
Look, where the whole world is currently, the flux that the whole world is, India is in a relatively better situation. But there is a big but. To say that we'll be an outlier in the global context, etc., nothing is going to matter as far as India is concerned, is out of the place. Of course, there will be a bit of decoupling, as far as the monetary policies of the US are concerned, or global markets, developed markets are concerned, India, somewhat deviating. You have interest rate hikes, or let's say pause. You have inflation problem. Here, interest rate cuts are happening. You don't have an inflation problem. Healthy demand because we have a 75% domestic-facing economy, not so dependent like China, which is majorly export-oriented economy. So, a lot of positives as far as India is concerned. I think, maturity of the retail investor has gotten better over a period of time. If during the last 3 months, SIP flows have been very healthy, in spite of January, February and March, I mean, it tells you about the maturity of the retail investor. No matter what the pundits come and tell you.
So it's not overt optimism, it's maturity.
It's maturity, it's financial literacy. Because I think the retail investor has only gotten smarter with the passage of time, seeing a lot of ups and downs. They have become very discerning. It's not like one size fits all. It's not like a herd mentality. There's a pick and choose. Of course, there is momentum at the margin which people get swayed to, but it self-corrects, and excesses which get created on the upside gets corrected. But the same story is again back. Go to find the next bit of stocks which are fundamentally sound and deploy your capital. So I would think it's a lot to do with the maturity of the Indian investor. Nothing more than that.
Where?
No, I mean, across the marketplace. See, the retail money
No,
is...
I'm asking, so
Where
you
would
said
you
deploy
deploy?
the capital, right? So
Where?
now my question is, at 22,000 you would have bought some stuff. Where is it that you're still confident?
Neeraj, I've been optimistic about consumption in a big way. I've been articulating that
Yes.
consumption is going to move at the margin in terms of sectoral preferences. There's so much of... See, the cat is out of the bag as far as the US is concerned, the uncertainties around the macros out there. There'll be a lot of if and buts. As far as capex is concerned, as far as tech spends are concerned. And that is going to have ramifications for all import-related sectors, export-related sectors. That is for one. Secondly, when things are moving in the right direction as far as the domestic consumption side of things is concerned, the income tax cut of 1 lakh crores, right? The interest rate cuts that are happening, the collapsing of the inflation number that we are seeing, the 8th pay commission recommendation that are due from April 1st next year, which is again going to boost incomes of the government employees. That's all positive at the margin as far as the consumption are concerned. IMD has come and said that monsoons are going to be normal. If the rural income, which is showing some green shoots, vis-a-vis the conditions that prevail over the last 2 years, you're going to have a Goldilocks scenario as far as the consumption is concerned. And that is where the pendulum is going to shift away from the capex to consumption. That is where the next round of growth, according to me, will come in the Indian market.
Okay. I have a follow-up to that, because if traditionally, and I'm only talking about my own experience, we're talking about a decade and a half back or so, 2 decades, right? So, but traditionally, if you say that you're trying to map rural consumption and you're saying that consumption is going to improve, you would look at two-wheelers. You would look at certain other things for the agri sector. You would look at tractors. Do you play it the same way, though, Manish, when you say consumption and you say that there's going to be an uptick? What would you deploy in if you look at that big... it's a pretty big basket.
So, discretionary side of things would be preferred as opposed to, let's say, staples. Staples are very fairly penetrated categories with anemic volume growth, because penetration it's a play on premiumization, and you compare that with valuations. Valuations have little comfort in most of the known staples, right? But consumer discretionary, a lot of things can go right. When you are talking about, let's say, premiumization or per capita income going up, and within the two-wheeler space, it's not the entry-level bikes. It's the mid-premium segment.
150 plus, 150cc, yes.
These are the segments which will see growth. Let's say Bajaj is talking about, or let's say Eicher is talking about. They have already guided for, let's say, million bikes plus. You know, that is an upgradation in terms of the volume. This is a story which is going to play out very well. Or let's say travel, airlines, hotels, the shortage of rooms all over the country. This is only going to get accelerated when the common man has some money in their hands. Let's say QSRs, the Zomatos of the world, you know, then you have fast fashion, retailing. These would be some of the area, leisure, entertainment, mediclaim. I also think housing demand, the mid-income housing segment, which had collapsed over the last 2-3 years because the savings were not there, because there was a lot of inflation, there was a lot of hit on the common man's spending on housing, home improvement. These are some of the segments which will come back in the latter half of the year. These are some of the areas of consumption where you should look at. Tractors, you alluded to, when you look at the rural side of things. Tractors is one of the areas where definitely things are going to move at the margin. Premiumization in groceries, these are some of the areas which will play out. And mind you, these are some of the names which have really not done well over the last 2 years. You know, they have been at the receiving end of the momentum, you know, which has gone to the capex related themes. Now it is their turn to actually lift the heavy metal when it comes to the direction of the market. So allocation moving away from investments to consumption is the big theme that is likely to play out. And I think BFSI is a no-brainer. And within the BFSI, you should also include insurance. The insurance companies' valuations are at rock bottom levels. You know, if you consider the long-term
trajectory. They haven't done anything for the last 5-6 years.
Yeah.
That's what I'm saying. The health insurance companies, the life insurance companies, when you have clarity around the taxation, you know, aspects of the insurance company, these are some of the sectors which are available at very reasonable long-term growth at very reasonable valuation. This is again the time to look at some of these names.
How big a factor for you while looking at a company or a clutch of companies, Manish, is their exposure to global trade volatility? Because we keep talking about India being relatively fine, and then sometimes there is the kind of excitement which is not really rooted in fact. For example, you have one set of export-oriented companies suddenly running, thinking that everyone's going to move their facilities from Vietnam and Bangladesh overnight to India. It probably will not happen anytime soon. So how do you distinguish there, and would you then play safe with more domestic-facing companies that are relatively untouched by global trade headwinds?
No, so I think you got to understand India's relative positions in which of the sectors does there exist a right to win. So let's say export-oriented sectors like pharma. You know, there is a right to win for India.
Correct.
Very, very difficult for other countries around the world to do what we do with formulation exports to the US, you know. And again, I think this narrative around tariffs, you know, headline that Vietnam is adverse to us, or let's say Bangladesh is adverse to us, or Pakistan. You know, these are because our rates are lower and their rates are higher. So, you know, there's going to be a shift of trade happening, China +1 and all of that. That's very good in terms of narrative for the short term. But at the end of the day, I think it's deal making, it's brinksmanship. Ultimately, the numbers, even for China, are going to get settled between 20 and 30%. Then this whole narrative about China +1, it's not going to be that easy. But within the export-oriented stories of India, an IT, a pharma, some bit of auto components, gems and jewelry, apparel, we have established a place. You know, we can get benefited at the margin, but it's not going to be earth-shattering, at least in the short term. It's more about narrative rather than reality as far as the numbers are concerned for the short term. I think we got to all wait for the last word on tariffs to come out. You know, and this whole deal making and 90-day pause, etc. We'll hear a lot of things.
The problem is last word could be in 90 days, 60 days, after 4 years. We don't know that bit.
But then the markets could be at 26,000 too.
No, it's just pure maths, you know, 26,000, let's say 22,000 if it's that floor, and 10% on that growth.
We are at
is 24.5. We're already there.
Right.
Now it's about the next year's growth of 10 to 12%. So in all probability, in the next 1 year, we'll be crossing that 26,277. It's just based on the fact that 10% growth you build on the Nifty which is very, very doable, because, we are mostly domestic centric.
And you're saying 25 bakes that in? 25 at this juncture bakes that in?
100%. For the next 3 months, if you were to move beyond 25, again, there'll be a propensity for the markets to correct. But the thing out here right now is that previously the DIs were buying, retail was buying, FIs were selling. That was getting balanced out. Today, the FIs are buying, the DIs are buying, and the retail is buying. With 20,000 crores just put in, you have a 10% vault in the Nifty numbers.
Yeah.
That is the surprise factor. If the numbers come in like this from the FIs, good companies will be available at a premium. It won't be available at reasonable valuation.
So Manish, then tell us. So one is the Nifty, right? Let's assume the index consolidates, right? You guys in that Emkay conference had a plethora of mid-sized names which did really well, right? Where is it within the non-Nifty 100 basket that you still find both the combination of value, growth, and the appetite to buy?
Consumption.
Only a consumption again.
Consumption, you
But
have...
then FMCG is out because FMCG is
is
large
out.
cap. So what do you buy then? Two-wheelers is out, all large caps.
Yeah, it's a large cap,
So
but
what do you buy then?
let's say
Mid-size?
consumer durables. Look at air conditioner companies.
Havells has said that it is a problem this quarter.
No,
the
but
stock-
yesterday BIS standards have got relaxed for compressors. Compressors was the big problem. If BIS certifications were not relaxed, India could have had a shortage of compressors, which means that this season we are going to sell 1.5 crore ACs.
Okay, but then in ACs, would you say that you like the volume players, or do you like the guys who are slightly more premium?
No, it's a mass play. It's going to be a very hot summer. You look at the Voltases of the world and the Blue Stars of the world, and this is a story which is going to play out over the next 2, 3, 4 years also. India is now getting backward integrated except for compressors. We are mostly backward integrated. Penetration is very low, below 10%. The right to win is there. Some of the smaller liquor companies available for less than $1 billion market cap, that's a premiumization play. Like you look at some of the IPOs which have corrected 30, 40, 50%.
Yeah.
The going is not that bad.
So not platform, not your platform plays necessarily. Or
Platform, I am not negative on Zomato. I think if there is somebody who has a right to win, it's Zomato who is going to be the last man standing. I hear a lot of stories and research reports around competition coming in. I think again, if there's too much of discounting, these companies, these competitors will run out of cash. The rationality will prevail, or one of the players are going to go out of the business, which will lower the competitive intensity. Amazon, Flipkart, Reliance have a long way to go before they crack the unit economics.
Wow, so eternal it is. All right, thank you so much, Manish. Pleasure having you in our studios and speaking with us. It's always great. Not more than 5 to 7% of cash, even at worst times. I think that's one top takeaway for me from this fantastic conversation.